Well, hello everyone. Art Alvarez at MortgageWorks, where we do have the answers and they're on the house. Happy New Year. Welcome to this year's first Mortgage Minute. So let's jump right into it. As you know, we usually like to talk a little bit about interest rates and the bond market to start with. So let's go ahead and do that. Just to remind you that you can check where current rates are on our website, on our rate grid. It's right there on the homepage. Jeff's got it up here now. And you can see that rates are still holding in there pretty well. But as Jeff just alluded to, the last few weeks, maybe the last month or so, has been pretty interesting as to headlines related to mortgage rates and so forth, because there's been a lot of headlines describing that mortgage rates have plummeted, that they're just dropping like a rock. And that's been somewhat the case. I think I pointed out before that we simply had gotten back to rates that were in effect in May and June, when at that time rates at these levels were not considered so great, but now they are. So it's all about perspective, because of course, not too long ago in October, when we were approaching 8%, we never did. We were in the low sevens. Obviously, if we're now in the low sixes, then that's a good improvement. Whether or not I'd call it plummeting, I'm not so sure. And part of where we're at right now is actually about a 0.25% increase over where we were about a week to 10 days ago. And why is that? Well, Jeff's going to pull up the 10-year bond yield chart where you can see what's going on. Not too long ago, in fact, here you can see for the last 5 days, going back to last Friday before the New Year holiday, the bond yield was quite a bit lower. In fact, at one point in late December, the 10-year bond yield actually got down to around 3.75, which is very good. Well, now you can see we're back up to about 4%. So as a consequence, mortgage rates have moved in a similar fashion, and we're now looking at about a 4% 10-year bond. And now mortgage rates, conforming loans in particular, when a couple of weeks ago we were at right around 6, now we're about 6.25. So again, that follows or tracks to the 10-year bond. So what's going on in that regard? What's happening in the financial markets to cause this kind of move? Well, there's a couple of things. First, I'll point out that the improvement that we saw in December with bond yields had a lot to do with the Fed's last policy meeting of the year in December, where the minutes actually just came out earlier this week, where it was apparent that the Fed officials have agreed that interest rates have likely peaked. So that did give the bond market some assurance that maybe we're past the worst of it as it relates to rates going up further, despite what we're seeing today with the bond yield getting close to 4%. The other thing that happened this week, because we were actually touching 4% on Tuesday, you can see that on the chart, and then we had this dip yesterday. So what was going on there? Well, yesterday was the release of the JOLT report. Remember, JOLT is the job openings and labor turnover. And the JOLT report had new job openings for December at about 8.7 million. That was or is a 32-month low. So that's an indication that things are okay with the labor market, but maybe not great. Also, what came out on yesterday was the ISM Manufacturing Index. It shrank. It has now shrunk for 14 straight months, ending in December. So those two numbers, those two data points, helped get us away from that 4% bond yield yesterday that was there on Tuesday. We were actually down to about 390 yesterday, but now we're back up to 4 today. What happened today, which is not actually on the slide, is we had initial claims from unemployment come out today, and it was lower than expected. So less people applied for unemployment benefits than was expected. That's an indication that the labor market is strengthening. So you get these cross signals about the labor market, and overall the labor market, I would say, is the primary focus on where rates are going to go and where the bond yields are going to go. The next data points coming out are not till tomorrow. That's the employment report and the unemployment rate. New jobs are forecast to be 170,000. That would be down from 199,000. So If new jobs turn out to be higher than 170, probably a watch out for. That would probably suggest the bond yield could get worse even from the 4% level we're at right now. The unemployment rate is forecast at 3.8%, actually an increase from November. So if that proves to be true or ends up even being a little bit higher, and if the new job forecast turns out to be a miss on the downside, meaning new jobs are lower than 170,000, that might give us reason to cheer a little bit, and we might see the bond yields come back down. So overall, though, what I want to point out is that, as Jeff mentioned again earlier about headlines, yes, mortgage rates did improve nicely in December. Plummet, I'm not sure I would use that adjective. They did improve nicely, but we're still pretty solidly in a 6% plus level. I would argue that's not bad. That's pretty normal historically. And I think we are seeing some signs that more and more folks are realizing we are where we are and you got to move on. And if home ownership is in your future, I think you're better off to look at that sooner than later. Because the other thing, by the way, that came out recently was home prices. October, home prices nationally rose year over year about 4%. So home prices nationally anyway, some markets are different, are still going up. And if rates do improve any further, if we get into the fives and certainly in the fours, yes, more inventory will probably occur, homes for sale that is, but there's so much pent up demand, as I say all the time, I think that'll overwhelm that increased inventory, and home values, I think, will go up even further. So if you can figure out a way, and we can help you with this, qualify to purchase a home now, qualify for the financing, I think you're better off doing it now. Don't wait. Don't try to time the market. Get home ownership now, and then as rates fall, you'll have two benefits. One is you'll see some increase in your equity, I predict. That's my prediction. And you'll have that opportunity to refinance into a lower note rate later. So keep that in mind as you contemplate when you want to take a stab at getting into a home.